Hey everybody, Economic Ninja here. I hope you're doing well. We're going to talk about the Federal Reserve and their attempt to raise interest rates. They're going to be raising them, everyone's expecting, and I'm expecting it too, to raise 25 basis points, which equals 1/4 of 1%. Sounds really exciting, doesn't it? Well, it should, because it's the first rate hike they have done in, what, about 3 years? I think so, if memory serves me right. And I want to talk today about how it is going to affect everything from your credit cards, your savings, your home loans, to student loans, all that kind of stuff, okay? So without further ado, here we go. So first off, we'll start with credit cards. Now, credit cards have a variable rate. So it means there's a direct connection to the Fed's benchmark. I've got some notes here, because I can't remember all this stuff. Credit card rates are currently around a little over 16%, down from a high of 17.85%. See why I need the notes? According to Bankrate, but expect your annual percentage rate to rise when the Fed makes its move. Now that's exciting. That's a really cool thing. I'm joking, that's sarcasm, in case you didn't catch it. Now, first off, I have to digress a bit. I've been talking on this channel of how not to get into extra debt, and I believe there are a lot of people in massive debt, especially credit card debt. Now, this is something that is directly affected when the Federal Reserve starts to raise rates. And this can get quite scary, honestly, if they start to get into a spot where, like, let's say the ECB is talking about really aggressively raising rates, at some points even as high as 75 basis points or 3/4 of 1%. That could really hit people's bottom line, especially the fact that a lot of people can't just pay off their credit cards. They're going month to month, and it's a debt trap. It is death. I mean, I'm not joking. And a lot of people are getting into extra debt. So be very careful, okay? So that does directly correlate. A single quarter point rate, it says, increase isn't likely to flip cardholders' financial world upside down. However, all rate hikes, even small ones, are unwelcome news. And the truth is, the Federal Reserve is going to attempt to raise rates incrementally over time, which means this could be really bad for you. However, in my opinion, it's not financial advice, not a financial opinion. I don't believe that they're going to be able to pull it off. I think it's going to be too little too late, and they're going to have to regress. However, we don't know when that day is. We don't know when the Fed is going to have to pull back and lower rates again, because markets can stay insolvent longer than you can stay liquid. So let's just remember that. So really the takeaway from that is, do not get into any more credit card debt right now, because we're in a raising cycle, okay? So one solution, if you are in a revolving debt credit card thing, you should look for a credit card that you can transfer your stuff over to with a 0 interest rate balance for a period of time. Because then all of your payments are going to paying off the principal, and they have these like teaser setups, like, hey, if you transfer your loan over here or your credit card debt over here, we'll give you a certain amount of time at 0 interest rate, hoping that you're going to just go rack up your credit cards again. But some people have used this in the past to pay it off, okay? So that is a very important point. All right. Now, mortgages. No, actually, you know what? Let's go to cars. Okay, for those of you who plan on buying a new car, I don't know why you would, because it is absolutely crazy town. But the Fed rate will not really have an effect on that rate. The quarter percentage point difference on a $25,000 loan is about $3 a month, okay? And that's bank rate, according to Bankrate again. So that's not a ton of difference, all right? So that's it. Mortgages. This is the Economic Ninja with notes. See why I don't use notes? I don't got my cardboard with me. Mortgages. As the Fed raises rates long term, fixed mortgage rates are also heading higher, since they are influenced by the economy and inflation. It says the average 30-year fixed rate home mortgage has already risen to 4.1%, up a full. It's hard not to laugh when you see this. Up a full percentage point since November, and is likely to keep climbing. Now, to all the people, first off, I want to explain something. A healthy economy is where mortgages sit anywhere between 6.5% and 9.5%, 10% interest rates. I know that sounds crazy, because most of the people, no, I can't say that. Most of the people watching this video right now know those rates. They understand those rates. You have lived in absolute crazy town, bubble blowing up, bubble expanding world in the last, oh man, really 20 years. And when it gets back to that, think about where a mortgage would be right now. If a mortgage is sitting around 4%, right, with a 0% Fed funds rate, and we get that Fed funds rate back up to 6.5, and they did that in, they got the Fed funds rate, I want to say to 6.5 in 2004, if memory serves me right. That's not on the notes. And that caused just doom in the housing market, right? So if we're already at 4 and we get a Fed funds rate of 6.5, we could easily see 10% rates, right? Can you imagine what a 10% mortgage rate would be like right now on a $500,000 house? Be pretty expensive. It'd be a pretty expensive payment. So you can only imagine there's a day where all those people that say houses aren't going to stop going up, they're all going to be wrong. So that's what happens over time. Those people are wrong. So that is going to affect it, all right? Now, we don't know how often or how soon, because I believe banks are actually pricing in risk into the housing market. So I don't know if they will immediately try and raise their rates alongside of the Federal Reserve, but we'll see. Now, student loans. Student loans are very interesting because they're fixed, okay? They're fixed. So most borrowers will not be impacted immediately by the rate hike. However, if you have a private loan, those loans may be fixed or have a variable rate tied to LIBOR, which is the prime or T-bill rate. So that can be affected. So be cautious of that. If you have a private loan that is not fixed, that can be an issue, okay? So know that those payments will be going up. And then also, this might be at the time to look at refinancing. If you have a variable rate loan, knowing the Fed is going to start raising rates or try to start raising rates, this might be the time to refinance if you can get into a better percentage rate, okay? Now, savings. This is the sad thing. Savings, deposit rates will be much slower to respond because banks like to pay you nothing, all right? It says the Fed has no direct influence on deposit rates. They tend to be correlated to changes in the target federal funds rate. As a result, the savings account rate at some of the largest retail banks have been hovering near rock bottom, nearly a mere 0.06% on average. Now, let me explain that. The reason why we're having so much inflation, yes, it's a product of Federal Reserve crazy money printing and the government's out of control money printing. As a matter of fact, I think we just saw Nancy Pelosi talk about how essentially printing more money does not cause inflation. It actually helps inflation. She's nuts. See, and I want you to understand that. She's nuts. What she really means is by printing extra money and giving it to you, it dampens the effect of inflation because you can just take that free money and pay for stuff. But then over time, that money that was given to people to help pay for the overinflated stuff gets really overinflated. That's the beginning of hyperinflation, all right? So I want to be very, very clear with that. She's nuts, all right? That's absolutely not how it works. It is causing inflation. And the facts are the savings rate being so rock bottom low right now is hurting savers. Every month you keep $1 in the bank, as of right now, even a couple years ago, it's very hard to buy something tomorrow that's equal to what you could have bought it today for the dollar. You know, so let's say you go into the dollar store. Actually, this is a great example. About 3 months ago, you used to be able to, or 5 months ago, you used to be able to go into a dollar store and buy things for $1. Now you can't. You have to buy them for $1.25. And you know, obviously stores like, you know, Five Below and stores like that are popping up because they figured out inflation ahead of time. They said, this is we can't do that. So they got a lot more to go before they have to change their name to you know, 5 1/4 Below. But it's hurting savers. So that is just a really, really sad thing. But it's a true it's state of affairs. Now I want to talk about this last point, and that is I believe that the Federal Reserve interest rate hikes are too little, too late. And the reason why is to truly stop inflation dead in its tracks, the Federal Reserve would have to raise interest rates a little bit above or well above to really make a point where the real inflation rate is. And the facts are the government has been trying to hide this for decades and decades. And the one way they hide it is they take what's known as the CPI, the cost price index, and they change it year after year. They change to it, make little changes. Like things like energy. You don't need energy in the CPI. So it becomes the CP lie, as many people have said before, not my name, but I like it. So in order to stop real inflation, you'd have to slam interest rates above what inflation is, because then what would happen is your savings account would go up. You would all of a sudden get a rate of return, a good rate of return. You go, man, I'm able to keep up with inflation with just keeping cash in the bank. So why don't I do that? And the Federal Reserve and the government does not want to do that. Why? Because they got into a very serious, scary loop of borrowing money. And the Fed loaned out money. Now the good news is, I'm going to leave you on a great news. This is amazing. Because people are asking for good news. They need good news. The Federal Reserve is a private bank. It is not federal, and it has no reserves. At a certain point, somebody in the government might say, you know what? Because to make money, have it be created, the banks create it, right? The Federal Reserve is owned by some of the largest banks on earth, and they govern themselves. And their job is to maintain themselves, not you, not your healthy lifestyle, their lifestyle. And so in order to make money, they need somebody to loan it to. Either they loan it to us in the form of mortgages, credit cards, student loans, things like that, or they loan it to the government for stimulus. And all of that money is due back with interest. Well, what if all of a sudden the government said, we're not going to pay you? They would go broke. They've done it before. It's actually happened. This is not the first Federal Reserve in this country, but what's really cool is that they just, go out of business and they come back, decades later with a new name, and everybody forgot about it. Just like economic cycles. Everybody seems to forget that an economic cycle runs between 7 and 10 years. And then they have super cycles every 50 to 100, and we are in a super cycle. This is a commodities boom cycle, and this is a currency bust cycle. So that's the good news. There is a ray of hope, and do I see an end someday? I do. I see an amazing time, to be honest with you. However, we're going to have to go through some very serious times before that. So get ready, hold on, it's going to get exciting. And if you guys have a little bit of money and a really good credit score, good solid credit score, I'm going to show you guys how to crush it, because this is going to be unlike anything you've ever seen before. All right, guys, that being said, I thank you so much for watching. The Economic Ninja is out.